And I'm introducing calendar spreads because I think they're really powerful. And so I'm glad someone asked about a diagonal. I mean, a diagonal, just in case, for those of you who are maybe a little bit newer, a calendar is the same strike. So if we take NVIDIA, does it have the stock price on here? I don't see it on here, but I think it's 100. I don't know. It's around 150. I haven't looked. So let's say it's 150. So if you wanted to do an at the money calendar, you might sell the front month 150 and then buy some kind of back month, 3 months out, 6 months out, 2 months out, whatever it is, as long as it's later in time, then that becomes a calendar. Now a diagonal is simply at different strikes. So let's say we sell the 160 versus the 150, then it becomes a diagonal. They're all under the category of time spread. So, they're very interesting. They can be used so here's one like calendar put spread. So this is really cool. Absolutely love this feature because I like to use calendars in terms of earnings. So we know that the next earnings are August 9th. So maybe we'll buy something as close as we can to August 9th without going over, and then sell something, really any time before that, but depending on how many times you want to do it, if you want to sell something every week. And so ideally you're selling and you're collecting this premium, and it's lower. It's then lowering the price of that long option. So then by the time you get to expiration, you're either making money on that long option or it costs you very little. And then you let it ride for earnings. Now, what I like to do is I like to do a strangle, so I don't have to try to guess the side. Rather than doing just a straight put or a straight call, I might do a strangle, sell the strangle multiple times, and then I have a very cheap, free, or even I'm getting paid to own a strangle come earnings, and then I don't care what direction it goes as long as it goes. And that's a really cool strategy that I like to use in stocks that tend to be a little bit more volatile on earnings, like NVIDIA. So this will give you some ideas of, doing 1 week before, 1 day before, calendar put spread out of the money, calendar put spread, this is the opposite, buying I always sell the front month, buy the back month. There are, I guess, reasons to do the other, although it's pretty rare. You can even do it with something like an iron condor. I mean, this is just really cool. Like I said, I've barely scratched the surface of this. I'm going to spend a lot of time on it because I think it's fascinating. In terms of setting up a diagonal or a calendar, the only other way that, you could possibly, you can do, if you go to, if you know what stock you're looking for, again, NVIDIA. And after this, I'll tell you the story because it's hilarious. But if you want to do a calendar and you want to do it in NVIDIA or a diagonal, then you can do your spreads or your strategy payout and just kind of price out different strategies and different spreads, and then use the very cool, analytical tools that Market Chameleon has to kind of analyze it. So like this one's got a time spreads tab on it. So then you can just set things up here, and sorry, I don't know why things are taking a little bit longer to load for me here. Maybe my computer just doesn't like everything that I'm doing right now, but
maybe the chameleon's taking a little vacation, man. It needs a break. All those little chameleons on the treadmill get tired.
Dimitri's out there running. He's running in a hamster wheel.
Man, he's out to dinner. Only you and I are dumb enough to be working tonight, man. Only you. And
All right. Well,
tell us your NVIDIA story while we're waiting for that, man. What happened to NVIDIA?
Yeah, let me I
want to refresh the page.
All right, just was seeing if there are any other questions. Okay. So oops. Yeah, let me refresh this. All right. So what I like to do in the very little spare time that I have is I like to talk to like elementary school age kids about stocks, because I think it's something that like, oh, here we go.
Yeah, nobody teaches kids, man. It's crazy.
Yeah, nobody teaches. I mean, kids absolutely love the stock market. It was what I've discovered, and their teachers don't know about it, nor should they, and my wife is a 4th grade teacher. So, I mean, that's not, if they even have a unit on economics, it's very basic. It's very short. Absolutely. and what I found though is that like I think when I was around third or fourth grade, my aunt gave me a share in some like utility company, a couple shares. I think I ended up selling them after college for like a huge gain, but
Yeah, of
it gave me
course.
a reason. Back then, you literally open there, you couldn't look stuff up on the internet. You literally would go to the newspaper every morning and, and look at your price in that long list. You remember doing that?
Yep, for sure, man. Yep.
That long list of symbols in the newspaper, and I'd go through and find it, and it was a utility, and it basically never moved. But even it moved like a it moved like a quarter of the point or an eighth of the point, and I'd be all excited. But it was like Public Service in New Mexico. I don't even know if it exists anymore, and it was like 18 for like all of my childhood. And I might have sold it at like 40 or 50 or something like at some point. But I mean, it was only a couple shares, but I love doing that. So I'm like, you know what? I want to talk. So I have a 10-year-old, I have a fourth grader. So I went and talked to a couple of his classes this year, and they loved it. And then I went to just recently went to my wife's. She teaches underprivileged kids in like a low income area. And I'm like, oh, they'll love this, they'll really get a kick out of this. So I go and I talk to her class, and like, after I talk and try to keep them interested, the fun thing that I do is we do a stock picking contest, right? It's just like a 2-week thing. And I just pick stocks that I think they might've heard of, like 50 biggest stocks, but then I get rid of stuff that they probably never heard of, and get rid of stuff that like I do higher price stuff so they could actually watch it move. And, so, you get a lot of like
Apple, Google, Amazon.
Yeah. Apple, Google, McDonald's, that sort of thing. Walmart and I don't think Target was even big enough to make the list, but that sort of thing. And, they love it. So my wife's class of low income kids actually was by far the most into it. They checked their stuff every day. Like they have access to, what the compute, some of the the schools in low income neighborhoods, they get like a lot of grant money for different stuff. So they all have computers, and they could, where they can look up stuff. Or so every day they're like multiple times a day, they're looking up their stocks. So my wife was actually getting annoyed because they were talking about their stocks like more than anything the last 2 weeks of school. So we did the stock picking contest, and it's only like a 2-week thing, and we don't use options. So at the end of it, there are a few slots left, and my wife is like, all right, I'll pick one and you pick one, and then we'll compare. So I picked Nvidia. It's not something that a lot of kids, 10-year-olds have really heard of, so they left it alone. And so I picked it. And the last day of school was something like not quite 2 weeks later, and Costco was the top performing, and that girl got a huge big Hershey's candy bar with M&Ms or something like that, and Nvidia finished dead last.
Man,
absolutely dead last.
Beat out by a bunch of fourth graders.
And so I'm laughing about this, but then my wife, and I love my wife dearly. I've been married for 12 years, but she comes up and she's like, "You're supposed to be an expert at this. How did you finish last?" And I'm like, all right, like, how am I supposed to answer this? I'm like, first of all, like,
hey man,
picking a stock over 10 days.
The pros know how to lose, man. If you're not comfortable losing money, you're not a pro, man. You got to be comfortable.
Yeah, well, but I mean, what I try to tell these kids is that this is a fun exercise, and I want you to get used to tracking stocks. But really, if you're buying stocks, you need to look in terms of investing and holding it. Like, if you like a company, then you need to give it time to play out. And 10 days is not enough of a sample size for anything. And so I'm like telling this in the class, and obviously my wife was not paying attention. She's like, secondly, I don't pick stocks. I'm an options trader. Maybe I could come up with an option strategy for 10 days, but, and I'm sure there are technical analysts and chartists and stuff who do 10-day trades on stocks. That's definitely not something that I do. But meanwhile, we just had a list of names and no research, no nothing. And I picked one of the last 3 that was left. So it's just really funny.
That's good, man. That's good. I
But,
love. I love when I was in college. We did a stock picking. We had a whole course that was stock investing course. And to my teacher's surprise, I won that course. Believe it or not, I was in it with a fraternity brother of mine. He was like, "You just do everything," because he was older than me. He just made me do. I was like a freshman. He made me do everything, and we won. And hey, that got me psyched about it, man. That's part of the reason I got into stocks. But anyway, let's get to the next question. Mike's got a question for us. Can you see the question there, Jay? He says, on your calendar, can you discuss the strike and date selection? So we're getting into that, and I didn't expect us to get into chameleon questions, but maybe you can you see that question there?
yes.
Jay?
Yeah. Okay. On your calendars, can you just, okay. Yeah. And it's an excellent question. And it's one of those things again. All right. I'm going to go to full screen
Yeah, do it.
here. So, and since we're looking at NVIDIA here, so, it's a little bit, it's a little bit of a tough question because it really depends on your goals. So for me, the only time that I set up calendars is in a situation where I'm going to hold the long at
Mhm.
the end. So again, like for earnings, so it's pretty easy to time it in the sense that if I'm doing NVIDIA and earnings are August 9th, then I know that my last strike is going to be is going to be as close to that earnings date as I can get.
Yep.
So that one's easy. And then the front month really just depends on how many times I want to try to sell. Do I want to sell every week to try to get as much premium, as possible? Do I want to sell just, one time before then and just have,
Do you have a standard? Do you just go by gut feel on the stock, or how do you make that kind of call?
Well, it's for me. I think in terms of what I'm doing for my clients and for them, they and I mentioned this before that I don't want it to be too sticky. So I'm not going to do
Right.
weekly trades because they don't want to be in front of their computer every week. So
Right.
I might space it out. If I was doing it for me, I would probably not do. I wouldn't do NVIDIA. It's too close. I would do something that has a earnings in September, and then
Mhm.
I would sell July. Maybe try to get one. Yeah, June. So it's the end of May, so we could do June, July, and August. Try to get 3 sales and 3 collections of premium in there. Strike choice, I would just do whatever the at the money. If I was not doing a strangle, if I was
Right.
doing, let's just say a call calendar, then I would start with the at the money in June. July is probably going to be a diagonal unless the stock, miraculously is in the same place. And then the same thing in August. Again, I would do a diagonal, and then come September, then I'm letting the call ride. But the reason, that's the call in that case is you want to have an upward bias towards the end. If you don't have a bias on direction, that's where I would use a strangle. You could call it a double calendar or a strangle swap or even a straddle swap. There's different things you can do where direction is not important. Now,
Right.
if you're doing the calendar as a volatility slash short gamma trade where you're not doing it around some event, then it changes it that's so you're selling the front month and you're buying the back month. Um, Again, it sort of depends on what you're more focused on. Are you more focused on selling that front month gamma and trying to collect premium, or are you more focused on being exposed to back month volatility? So, uh, so I found that doing a front month versus second month calendar generally maybe high probability, but you don't really make a lot of money. So maybe you sell the second month and then you buy the fourth month or something. So, but again, you really kind of have to look at your goals and look at what the premium is. I mean, is the front month premium really jacked up for some reason? Do you think it's going to calm down? Do you think that back month volatility is underpriced? I mean, there are a lot of factors,
Mhm.
and it tends to be something that is just not um, like if I'm doing a covered call, there's a couple strikes that maybe I'll choose from. I have to make one choice, and that's it. If I'm doing a calendar spread, there are multiple pieces that are moving, and it's kind of hard to do a one size fits all, unless again you're doing a round of event, which is what I do. Um, because I think it's easier. Calendar spreads can be a little more complicated. And so when I'm dealing with clients in a service, it's like I want to have like more succinct goals. All right, we're going to play earnings, and we don't care what direction. We're just going to get a really cheap strangle to have on when Nvidia has earnings. So we're going to sell a bunch of options for a couple months before that, and then boom, we're going to have it. It's something that I could easily explain that people understand.
They understand.
And it's effective. It's also can be highly effective.
I guess, Mike, if you go back to the Mike's got another follow-up kind of question. He's saying some advocate on calendars we should skip a month so we can adjust the short if we, I think he's saying, run into trouble.
Yeah. Okay. I see that. Yeah. So, and I agree with that. Again, that I think that's a good point. I mean, if you're doing it, I would again say that if you're doing it for earnings, then it doesn't really matter. If you're planning on holding that back month long term, and you don't really care, you're just trying to collect the premium, and you're going to move your strikes with every month, then it doesn't really matter if you do the front month. If you're doing it as a short gamma / long volatility trade, then yes, I would probably give it, at least 6 weeks. Yeah. I mean, if you're gonna, I've done these really short-term calendars over the course of a couple of weeks, and they just don't pay out, they just don't pay off that much. And I just don't find it to be, I guess it's the sort of thing that if you're doing it in an index and you're doing it all the time, then maybe you can get away with it. But for me, it's not my bread and butter strategy. I would rather do a little bit longer term, maybe not. Yeah. Maybe into that second month, as you say. I certainly agree. I certainly understand why many people advocate skip the front month. And sure. I definitely, from experience, even though I'm not a huge calendar spread trader, from experience, I would agree that starting in the second month seems to make sense. And then you just have to decide, your back month, you can do the third, you can do the fourth. I mean, again, it kind of depends on how much you want to spend and how much exposure to volatility you want.
Hey guys, remember, I see Wayne, you're clicking questions in the chat. You got to do it because we can't follow all the ones in the chat, and Jay can't see them necessarily. So go to the questions tab. It's right underneath the video here. There's 3 tabs. Scroll down. You'll see a question tab, and go ahead and just copy and paste your question there. So next one, Mike is asking about credit spreads. Can you discuss how you might use the Chameleon tools to find good repair / replacement? I don't know what that means, but you tell me what that means.
Well, repair would be a situation where you're, long a stock presumably, and it's moved against you. And so you're trying to make up some of that money through premium. And replacement would just be, instead of actually getting long the stock, then you're doing a credit spread. So you could do a credit spread, you could do a cash secured put in that sort of situation. Yeah. And I love credit spreads for all those reasons. For all, although sometimes with repair, I will use covered calls. You can use both. You can use them simultaneously. I guess it depends on how quickly you think that, your stock might bounce back and some other things. But I will also use covered calls for repair quite a bit. I said, if you're really confident, you can sell puts and sell calls. And that's a really good way to try to get back some of that premium. Well, and again, there's a difference here, because if you're talking about repair, then you already know what stock you're looking at. You don't really need Market Chameleon to find
through, yeah.
And then you just want to look at, and then you're just looking at the option chains in a particular stock, and you're saying, all right, well, I have an opinion that Nvidia is not going to go much farther down. Maybe you're looking at a chart. Maybe you're just looking at delta. Like, I'm comfortable with a 30 delta and below. Here, let me go to this.
Go ahead, make full screen if you want to. Yep.
So we'll go to Nvidia option chain. So, so you might look at, all right, so I want to sell, I'm going to sell credit spreads every 30 days until I get my premium down to where I want it to be. So, let's just go to the monthly. Let's just go to the June 21st. Sorry, my thing's still going slow here.
Hear that
And then
squeaky sound? That's the chameleons on the wheel, man. Wee, wee.
Dimitri, run faster.
Dimitri, for God's sake, spin the wheel, my man. All right, cool. What's up?
So there's not too many strikes in June 21st. They don't have it broken down except beyond every 5 strikes. So we could either do, let's say, 35 or 25. I kind of use, let's say, a 30 delta as when I'm doing credit spreads. I typically don't go above 30 delta unless it's a special situation or I really feel strongly about a certain floor or something like that. So let's say you just do the 135 130 and you just say, I'm going to do it every 30 days. I'm going to sell whatever's closest to the 30 delta, and I'm going to collect, looks like almost $1 a credit each time. Of course you have to have an opinion that the stock is not going to, tank through those strikes. But like with NVIDIA is something that I do have a pretty strong opinion on. So that's what for replacement. Now, if you're talking, I'm sorry, for repair. Now, if you're talking about replacement and you don't necessarily, you're not super picky on what the stock is, then you can go and use, one of these screeners, which I've said before. I love the credit put spread screener here. I use it all the time, to sort of find, stocks, to look for credit spreads in, and then you can specify, so you may not have a certain stock in mind, but maybe you like certain kinds of stocks, and that's why you can go in here and you can pick your price and your market cap and your industry and your sector. So let's say I'm only looking for tech stocks over $100, then you can do that. And then you can go to the parameters and start messing with the parameters, how far out of the money using these deltas, how many samples do we have, so we might look at, theoretical win rate and then kind of sort by how many sample size we have. Like, does this one have sample size? I thought it did. I might be thinking of a different screener that actually shows you how many samples we have, but,
Yep.
but you could, what I usually do is I usually put a screener in for delta, to where the sell strike is not, is,
Do you have certain
30
stocks you like to use, like in a watch list for that, or you just do full market? You just look for everything. What's your general methodology?
I do
And
full market.
I won't make you show your watch lists if you want. I mean, I know that.
No, that's fine. I don't have a watch list.
People get a little testy with who's on my watch list, so I won't make you show them. But do you generally use that strategy, or you prefer to just look market wide?
I look at market wide. I may change pricing. So I may not, like, for instance, it's kind of hard to find a good juicy credit spread on a $20 stock, for instance. So I might do something where I'm doing over 100. I might do market cap, because I want to make sure it's going to be liquid enough. And obviously, well, not obviously, but, generally speaking, the higher the market cap, the more activity there is. So, you can also do that through volume. I mean, there's different ways you can sort by liquidity, but, a market cap tends to be a pretty good one. Volume tends to be a good one. And, that sort of thing. So, I mean, and then I will go through and I will look at stocks that kind of I'm looking for. So that might be tech stocks. Maybe it's resource stocks. Like if there's biotech stocks, I'll probably ignore them, but I like to see everything just in case there's something that comes across that's really interesting.
Yep.
But I kind of have stuff that I'm looking for, stuff
I
that I'm
think
more
almost everybody gets you do, for whatever reason, it's human nature to get a little bit of tunnel vision on, stocks you're familiar with, you think you're more comfortable with. I think that is, for whatever reason, good or bad, and that's why it's always good to kind of question what you're looking at. But it's very easy to fall in a pattern of stocks that you kind of feel comfortable with, right?
Absolutely. Yeah.
Yep. Cool. Let's get to Mike. And he says, in the last webinar, you gave us an idea that you have a volatility hedge against numerous credit spreads. Can you give details on how you create this hedge? Just give me the hedge, Jay. Please.
Absolutely.
We want the juice, man, the juice.
Yeah, no. And the funny thing is that I didn't realize this until, I started making friends with different fund managers and different volatility traders, so mostly through Twitter, which is a great tool again for finding some really smart traders who don't mind sharing a lot of their insights. But one
Yep.
of the things that's funny is that people will hold very close to their vest their hedging strategy, and I never realized until I really started doing it myself. Like, hedging strategy can be a really big deal in terms of your success rate. Now, I have no problem sharing it because I don't I don't have any secret sauce. I just kind of do what I feel works,
Sure.
and so far it's been good. But I'm still kind of tweaking it. So um, I like to what I do is and I can't unfortunately show you on this screen. If I had like my Thinkorswim account up, I
Sure.
could. But what I do is I have pretty much all credit spreads, and they all have a delta assigned with it. It's going to be a positive delta because they'll make money as the market goes up. So what I do is I will beta weight those, which is just simply a checkbox in Thinkorswim that lets you check beta weight, and then you type in whatever instrument you want to weight them to. So I weight them to the SPY, the
Hmm.
SP 500, ETF, and I do that because that's what I hedge in, and it's a lot cheaper to hedge in that than using the SPX, particularly for my type of clients and subscribers that I have. So I'll beta weight my delta based on SPY, and then I will have this sort of general delta number. And so I want to get that lower in case the market sells off. Now, if I'm really worried, if let's say the VIX is at an elevated level or the term structure's in backwardation or something like that, then I might just do a simple put spread in SPY. In case it completely tanks, then we know that we're gonna get max value or really good value. But if to save money on hedges, if volatility isn't too high, then what I do is a put butterfly. So I will pick once again, I will pick something usually starting about the 30 or 35 delta as my top strike, and then I will do a 10 wide or a five wide butterfly. That is, so let's say SPY's at 285, I might do the 280, 275, 270 put butterfly.
Yep.
And so that should cover any sort of moderate sell-offs. Now, if I think it's going to keep on going, then either I'll add another butterfly or I'll just change it into close it and put on a straight put spread or something like that. So the key is that I think the key there is the beta weighting and then trying to use that index product to get that delta down to a more reasonable level. But I don't have a sign. I mean, certainly funds with endless resources have tools that tell them exactly how much they want to hedge, what strikes, maybe even different products and things like that. I'm kind of doing it by feel.
Hmm.
Um, if I feel that volatility is not showing a big sell off, then I will stick to my flies. And so far, they've worked really well. Because instead of spending, let's say $1 to $1.50 on a put spread, I'm spending 40 to 50 cents on a butterfly. So
Gotcha.
it has worked really well so far. I've never blown through my butterfly strikes at any point. We've cashed a couple out, as winners, and if they lose money on them, that's great because that means the rest of our credit put spreads are doing really well. So,
Yep.
at some point, I would like to make it a little bit more, systematic, where I have some sort of strategy that, like, if we were writing an algorithm, I would sort of know exactly where I want to put my hedges. But right now it's really I've been doing this for a while. This is what I think, sort of
Yeah.
deal. Which is
It's called the
not
algorithm in your
necessarily the best
brain,
way to
dude. It's your brain. Yep. That's cool. Oh my God. Well, if you guys don't see what's happening here, I have a cat on my desk. He's decided that right now is the perfect time to watch Poppy do a show. Here's the kitty cat. There he is. He's going to do the rest of the show, Jay, if that's possible. All right. Yeah, Ben. Hey, kitty cat. Oh my God. Cats and dogs living together. Gary is asking, of all the option selling strategies, which do you find that you use the most? I think we talked about this a little bit in the last show.
Yeah, that's easy. I use credit spreads. I use put credit spreads the vast majority of the time, and And so this is something I like to talk about whenever I do like my money show and Traders Expo presentations. And I talk about having sort of a trading DNA
Hmm.
where there's stuff that you're just kind of comfortable doing that just kind of fits your personality. And for me, that's selling credit put spreads. I mean, yeah, I could sell credit call spreads pretty easily, or iron condors. I mean, we're not talking about a big leap from there. But what I'm most comfortable is finding put credit spreads. And that's because I feel pretty good about my ability to find stocks that have floors
Hmm.
that for one reason or another have sold off but they're kind of done selling, and I love selling credit put spreads in those, or just finding situations where I just feel that you know that the puts are overvalued and they're going to come down. And I'm certainly not perfect at this, but I probably have like an 80% win rate in my service in terms of just doing credit put spreads. And whenever I stray beyond that, outside of hedging, of course, then
Right.
I tend to get into trouble. So um, that's why I'm slowly adding calendars, because it's something else I'm comfortable doing, but I don't do it nearly as much. But whenever when I was doing condors, for instance, I would never run into issues on the put side. I would always run into issues on the call side. It would always be where I was fine picking a stock and it wouldn't go below it, but it would always shoot through the top. Like that happened to me like way too many times. I'm like, why am I doing this? If I'm right on the put side so many times,
Yep.
know. So I mean, it's a DNA thing. Like I know other people who are comfortable selling call spreads but are scared to sell put spreads because they feel if the market tanks there that everything's going to tank, and that's true, but which is why I hedge the entire portfolio.
Yep.
So that's how I get around that. Another thing that and this isn't really, this is more of sort of longer term investing, but I love covered calls, cash secured puts, but cover calls in particular. I absolutely think they're the most underrated sort of basic trade in the world, and that everyone should be doing covered calls all the time. And so that's something I'm very comfortable doing.
Yep.
Um, too. So I would much rather have a covered call than just simply buy and hold. But again, it's a DNA thing. It's like you find things that you're sort of comfortable with. I'm generally comfortable on the short side of volatility. Um,
Yep.
you know, uh, there are some people who would much rather be sort of long volatility, long gamma, and kind of tread water until something big happens and then make
Yep.
all their money in like a short period of time. And I mean, you kind of have to find what you're comfortable, what you can sleep at night
Yeah.
doing.
Well, you exactly. I used to work with a guy on the floor in Chicago. God, I worked there like 8 months, and the entire time I was there, his name was Coach, and Coach, this big giant guy, was like, "It's gonna hit, it's gonna hit." He was always had this. I don't even know. I had no idea what it was, but it was this like super rare. He was waiting for this super rare event, and when that event happened, he was gonna be ready. By God. Jake's asking, any reason why credit spreads rather than debit spreads? Is it a time value of money thing?
It's more of a probability thing.
Yep.
I like debit spreads, and so I have like an entry level service, which is just trying to teach people options. And I just do buying calls and buying puts in there, or buying straddles and strangles, which is just buying calls and puts.
Mhm.
And I do that, even though in some ways I hate it, because I'd much rather be doing debit spreads. But usually debit spreads take one more level of option approval, and I want people to be able to get into the service with the most basic option service possible. Like,
Right.
and I want it as easy as possible. But ideally, if I'm taking a directional bet, I would use a debit spread, and that's what I do personally. If I take a directional bet on anything, I use a debit spread. I never pay unless it's a really cheap call, like let's
Right.
say under 50 cents, maybe up to 75 cents in some cases. I never pay full value for options, because, and this gets back to your original question, because time value is always moving against you, right? I mean, every single day your time decay is ticking against you. And with credit spreads, you collect that. You can also have, pardon me, you can also have some directional opinion. So if you feel like, I don't like this whole neutral thing, I want to have an opinion on direction because I feel pretty strongly, you can still use credit spreads for that. And debit spreads are if you have so a more definitive opinion, it might be good. Like I find it, particularly good for ETFs or like commodities or index or something where it's a sort of a macro level thing that you think it's going to go a direction. I'm a big fan of debit spreads for that. For stocks though, credit spreads, I'd much rather be collecting. That's again, it's a DNA thing. But I'd much rather, my 70-80% probability of collecting and then manage the losses when they come, rather than dealing in a situation where I'm mostly losing and I have to wait for, I have to pick those winners a little bit more frequently.
Let me jump. I'm going to jump ahead to Gary here because it's along the same line. He says, on credit put spreads, what deltas do you gravitate to for sell/buy?
I like my upper strike to be about 30 delta, unless we're talking about like a really volatile stock. And then you can usually get the same amount of premium, like down at like a 20 or even less. So depending on, sometimes there's some really good situations where you can sell a 20 and under and get what you're looking for normally. And I'm trying to look for usually 50 cents to $1 is kind of the range I'm looking for. That's usually about 30 delta and below. Some people don't mind taking a little bit more risk and going higher. Some people would rather collect less money and go farther out. Again, that is a sort of a personal preference thing, and you kind of have to test with your risk tolerance. Like, what am I comfortable doing? I mean, I know people that sell weekly options in indexes and use 5 deltas for their sell points, and they do it every single week in and week out, and just collect 50 cents on the SPX on a 5 delta option every single week. So, I mean, there's lots of different ways you can do it. I have found that kind of 30 delta is my cutoff line personally, but there's no research behind that. That is a personal preference thing.
Let's go with Mike again, who's on the similar line. He says, in repairing a credit spread, do you prefer to roll out in price or time or both?
That's a great question. Like, if I've kind of come to the point in my career where it's kind of a binary event for me. Either I feel like I messed up and I'm just going to close it, or I feel like I'm right and I just need more time. In which case I will roll out and I will roll down too, or whatever. If we're talking about a put spread, I will roll down and out, or if it's right at that level, I'll just roll out. But yes, I'm trying to get to the point where I don't roll at all. I'm trying to get to the point where if I have a loser that I just close it, but I'm too stubborn for that.
Aren't we all, man?
There are trades that I just like, and I know I'm going to be right on, and I hate taking a loss on. I'm like, I'm going to wait this one out if it kills me. And generally they do hit, but it causes a lot of stress. And, but yeah, I mean, if there's something that I feel it's some fluke, like a company that sold off because the market sold off because of the China trade deal. However, the China trade deal has absolutely zero effect on it or anything that it does. And it's just a matter of needing a couple updates in the market, or, that's a situation where I'm like, all right, well, let's just roll it out for a week or two. Every once in a while, if it's some kind of like event where you're kind of teetering, like, okay, I'm not sure either the market's going to keep going down or the stock is going to keep going down or it's going to bounce back quickly. Every once in a while, I will add a debit spread hedge on for a very short period of time that will cover the initial cost of the trade if it does keep going down, but doesn't eat up all my credits, so that if it does bounce back, I can still make money. It's a little bit more complicated, but I will occasionally add so just to summarize, I will occasionally add a debit spread trade short term to cover potential losses if I feel it's something that I might roll out, but I just need to give it time to decide if it's going to collapse or if it's going to bounce back, like it's kind of an up in the air situation. It doesn't happen that much, but I do every once in a while. Again, I try not to get too sticky with the trade.
This is kind of a follow-up on that. Gary's asking, for your credit spreads, do you use a profit target or hold to expiration? So that's right along that line.
I never hold to expiration unless it's something that's so freaking obvious. You're so far in the money that it just doesn't matter. But what I try to do also is I try to be cognizant of my subscribers' accounts. So it's like I tell them they can do my credit put spread service with $5,000. In fact, I do all the trades and I do it in a $3,000 account. So if I want to do more than, let's say, 4 trades, I have to close one in order to do another one to free up the margin. So I might close something out early in that sense, but normally I'm looking for under 20 cents. Usually what I found is that you get to a point where there's about 10 to 20 cents left in the credit spread, and then that'll just linger until the end. And so you can make, $10, $15 per spread you have on, which isn't a lot of money. Meanwhile, you have a lot more risk. And so at that point, usually under 20 cents, I'll just close it and we'll move on.
Sure.
And I've made, 50 cents on it or so. So I'm trying to make about 50 cents per spread. So usually it is a profit target.
The good answer there. I'm just going to answer this for Jake. He's asking what brokerage do you use, but our lawyers have told us it's not a good idea to tell people that. If Jay feels comfortable with that, you can just shoot him an email and he can talk to you about that. But we don't tend to answer those sort of questions here on the Chameleon. Jake, sorry, buddy.
I use Adam.
It's just a legal thing.
He's my Adam actually has a direct access to the floor. I just, I use my next. Just kidding.
Mike's actually asking again.
For your lawyers, I'm kidding.
For my lawyers, yeah. So always, I mean, you get it too, I'm sure. I mean, it's literally people will send you emails, asking for all these sort of recommendations, not only for what stocks and options to do, but who can manage my money and this sort of thing. And we try to stay away from that altogether, just to not even get into it. Mike's got a follow-up here. He's saying, can you repeat on your hedge butterfly for credit put spread? Is it centered OTM short strikes on the 30-day or 30 delta puts and then spread long wings out a couple of strikes?
A great question. And let me specify that the butterflies that I use for hedges are debit butterflies. So I'm short the middle strikes. And I'm long the wing. So that's a directional. When you're using a butterfly to choose a direction, you want to use the short the middle. I'm not going to say long or short because depending on whether or not it's an iron or a regular butterfly, then long and short are like opposite. So I'll just describe it. I want the middle strikes to be short strikes. Usually I will have my long wing starting around the 30, and then I will go about 5 under to my double short, and then another 5 strikes down for my long. Usually I start it at about the 30. So with the long, but directional, you want to pick a point where you think it's probably, if it sells off, you pick a point, like let's say the 50-day moving average or something, and pick a point where you think there will be, resistance where buyers will come in and say, you know what, I don't think we're going to go any further, farther, or if you're in more fundamentals, like pick a point where you feel like the S&P's yield, overall yield is something where people like to buy, or whatever point you decide, or just just gut instinct or whatever you do, that's where you want to put your short strikes. And then I go 5 around it. You can do if you want to set, if you don't mind spending the money, you could do a really huge, like 20 wide butterfly, but then it's basically the same cost as a put spread. So you might as well do a put spread, so there's a lot of different ways. I like butterflies because I know my subscribers hate losing money on hedges, but I'm not going to do a full put credit spread service without protecting against the downside because of the nature of everything to correlate when the market sells off. So, so the butterfly to me is just that good sort of middle ground of not spending too much out of a hedge. And as long as the market doesn't, flash crash all in one day, you have time to adjust it if the news starts getting worse.
Right. Mike's saying if you liked if you like the covered calls, do you like the poor man's covered call or diagonals?
Absolutely. Absolutely. I call them synthetic covered calls. Absolutely. I love them. It's a great way to do it. You can essentially, create the exact same situation as you can with a regular cover call. I mean, minus the dividend situation, which you kind of can get depending on your timing and stuff like that. But yeah, I mean, The only reason why I find that people don't do the diagonals for covered calls is just because they don't understand it and it's a little harder to visualize. But absolutely, it's far less capital intensive. Um, I have a lot of people in retirement, so they already have long stocks. So selling calls against it makes sense. If
Sure.
you're going from scratch, then you know I would just assume do a diagonal over a covered call. But again, it's much easier to explain a standard covered call than it is to explain a diagonal to people who are relatively new to options. So
Yep.
there is
Yep.
that factor as well.
Totally. Wayne saying you mentioned point 30 as the upper limit goal for the far option. Do you have an
Mm.
option reasonable goal for your net delta?
Yeah, that's a good question. I honestly don't really look at net delta all that much. I look at the impact on my portfolio of that beta weighted delta. I rarely look at I rarely look at it separately. I kind of, I do in the sense that, I will adjust. I would kind of look at my net delta, and then I will just adjust the amount of flies I do to kind of lower it. I think they tend to be around 15. If you do about 30 days, they tend to be around 15 delta. Um, but I'll have to look at that, and
Sure.
next time I will look at a more exact number.
Cool.
It's funny because it depends on how much time there is and sort of how volatile the market is. That'll impact that net delta number. So I kind of just look at the overall impact of my portfolio. But I let me make note of this, and I will actually look at what exact delta I've been using on my flies, and
Nice.
I'll next time I
Something
will
to look for next time. Nice.
something exciting and fresh.
Jake's asking, do you ever take naked positions?
No,
Yeah.
unless you're talking about a cash secured put, that's not
Yep.
really naked because you have the cash to buy the shares. But and in that case, you don't mind being long the shares. But no, absolutely not. Only as a market maker, and that's because we were trading delta neutral anyways.
Yep.
But no, as a position trader, I have never taken a naked position that's not a cash secured put, and I absolutely do not believe in doing that in any situation. Even professionals,
Even if you know what's going to happen, Jake?
unless you have a time machine, in which case I'm okay with that. All we have to do is look at one example of the optionsellers.com. I'm
Yep.
sure we've all heard of has everyone heard of optionseller.com?
Have you
That's
guys
the
heard of that?
it was a big newsletter trading service that was around for a very long time,
Yep.
and he sold I can't think of his name right now, out of Florida, and he sold naked calls on natural gas futures, and it worked for 15 years uh,
It
until
works
the day
until
it
it
didn't work.
doesn't.
Yeah, it worked for 50, however long it was, 10, 15 years, until the day it didn't work. And he lost 150 million of client money,
Oh,
including the
gosh.
owner of the Tampa Bay, or of the Tampa Bay Rays, I think, had a big stake
Yep.
in it. And I mean, it's just not worth it. You know, it
Yep.
spend the money to buy even a cheap option, even if it's 10 strikes away or whatever. I mean,
Yep.
just be able to go to sleep at night knowing that you're going to be able to
Absolutely.
trade.
Absolutely. Guys, we're wrapping up here. We're right. I promise to finish this thing in the hour. So we might be able to get one, maybe two more questions here. Jacob is also asking, do you ever use synthetics rather than a pure equity plays?
That's the sort of thing that yeah, I mean, sort of as a market maker, was more into that stuff. As a position trader, not really. Mostly because it doesn't really fit in the type of strategies I do with my clients. Absolutely nothing wrong with using combos or conversion reversals or however you plan on doing it to sort of do a synthetic long equity. Absolutely nothing wrong with it. I just don't do it because it doesn't really fit in with my current lifestyle slash newsletter type stuff that I'm doing. But nothing wrong with it.
Yep. Yeah. Last question, Steven. On a diagonal, what's your criteria on picking the underlying?
It's a good question. So for if I'm doing it, if I'm doing it for like an earnings play, then I want to pick something that has some volatility, but not a ridiculous amount, where I think it might move on earnings, but it's probably not going to be too crazy beforehand. Nvidia tends to be a pretty good one for that, moves a lot on earnings, but is not necessarily too crazy. I mean, every once in a while, like whereas opposed to something like Tesla, which is just too crazy all the time, including if I'm doing like, let's say more of a, a poor man's covered call, a synthetic covered call, then I might do something that again has enough volatility to make it interesting, but not too much to where you think it's gonna, you have to worry about moving your back month long strike because it's moving that much. So I mean that, might be I don't know what's a good example of something like that. I have to think about that. Maybe like a Microsoft or an Apple, something that's probably not going to tank because it's just too big of a market component, it's only gonna tank if the entire market tanks, but has enough
Sure.
volatility because they're still tech stocks to where you can get some juice out of it.
So I guess until next time, everybody. Thanks so much, Jay. You're the
Thank you.
man. Love you,
All right.
dude.